Welcome to the show. All right, we will be definitely asking you about long-term strategies or revamping or reshuffling strategies for a portfolio. But then, having said that, let's just focus on this uncertain times and the way market is reacting to it. GST, we did see that the market did not, take it for a very long time in stride. But having said that, a very crucial meeting coming up next week, the FOMC. I know I'm talking about short-term triggers, but how do you make sense of this current market momentum?
Sure. So essentially on the FOMC, I think so it is a given. The probability is like, possibly we are headed towards, if not, uh, two, possibly, three rate cuts. It is happening after a long period of time. The unemployment data in US has not been very constructive. Obviously, we have seen two downgrades in terms of the unemployment numbers. What is very critical at this juncture is to focus on domestic rates as well. We believe that the spread between US 10-year and Indian 10-year is at a record low, which creates a very good environment for cost of capital in this country. Obviously, it has got far higher implications on valuation. We also do believe that we are in an environment wherein the only joker in the pack has been earnings. And as and when we see earnings growth getting delivered in this market, we are going to see, possibly strong, comeback of possibly the highs that we witnessed. 15 months, markets have been in a zero return sort of a period. And what we have observed is that once you get these 15 or 18 months of no return periods, and you have seen other markets rallying at the same time, the relative attractiveness of India as a market goes up. And that obviously gets reflected in the emerging market premium that India has enjoyed over a period of time. So if you look at market purely from a mean reversion standpoint, the way FIs have been positioned in terms of very low ownership, this is a perfect recipe wherein if earnings growth gets delivered, market returns will follow.
Hi, good afternoon, Aditya. This is Ankita also joining in. Aditya, like you mentioned, that perhaps earnings is the only trigger that we have been waiting for, because there have been a couple of positive triggers, and we are still in a range. We are in a time-wise correction that's going on, but if the earnings happen to be good, do you still think that that could see a greater upside for the market, because we are still expensive? If you look at the forward PE for for Nifty, that's 22 times, which is already above the 5-year moving average. Do you think we are still expensive? There is more correction on the anvil before that up move comes in?
See, one of the things in terms of it's a relative premium to or their slightly higher PE multiple can be easily justified by looking at the superior ROE profile that the market has had. We are a 14 to 16% ROE market if you look at the broader indices, and I'm talking about the Nifty here essentially. So, the P multiple has to be looked in conjunction with the ROE profile of the market. So that is point number one. Point number two is that if you look at structurally what has happened in the market from 2021 to 24, we saw 25% earnings growth getting delivered, and earnings practically fell off the cliff in the sense that we saw 4% earnings growth getting delivered in FY25. I think so. It is more a question of mean reversion in the market. So if you look at the long-term trends, 15, 20 years, earnings growth has been, 12%. And that is practically the return that, Nifty has also generated, which is nothing but a combination of inflation plus the GDP growth in a market like India. So we believe that we are in a mean reverting environment. 10 to 12% earnings growth. In the best case, it can go to 14. The days of that 25% earnings growth, which was an aberration, and we will treat it as an aberration essentially because it was on a very low base of many industries getting impacted on account of COVID, so on and so forth. So that is the reason why we believe that earnings is going to rebound strongly, and if earnings growth is going to be 12 to 14%, I think so. Markets could deliver that kind of return, and PE more or less will remain constant.
All right, Aditya, let's look into your sectoral bets also. As per the details, healthcare almost 39%, financials 22%, consumer 11%, telecom 10%, and technology 9%. I want to understand the rationale behind this kind of an exposure, and also, are you planning to step up your exposure to consumer or consumer discretionaries?
Yeah, so essentially, the rationale is that we have been fairly defensive in the last 15 months, and that is why you see healthcare sector like healthcare getting featured as the, largest exposure. And our rationale has been very, very simple. Within healthcare, we have preferred companies on the CDMO side, which are more driven by research, either who benefit because of the trends in big pharma globally or biotech, sort of spends. Another very important critical allocation for us has been diagnostic stroke hospital plays. They don't get impacted by tariffs. The only piece in healthcare which gets impacted, and it is a very nascent stage wherein we get this news that possibly there is going to be some tariff on pharma. So we have completely insulated our healthcare exposure. On the consumer side, definitely, I think so the narrative has changed. So what we like on the consumer side is either low unit consumption, wherein we have seen a very, big GST cut coming through. So we believe that within the rural and the urban complex, we will prefer, the rural consumer companies today. Because gold is up 40%, and I've always believed that gold is a balance sheet repair for rural India. Essentially, now the gold number is like 25,000 metric ton, which equates to close to $3.6 trillion of gold that we hold. Plus, the rural incomes are improving, and obviously this GST cut is going to act as a big booster to consumption. Another very simple point here is that we have the 8 pay commission arrears, which are going to have a 0.75% impact, positive impact on GDP. We have typically seen that in a lot of low unit consumption categories, be it air conditioners or fans or two-wheelers or small cars, there is a pent-up demand which could surprise on the positive. So that is why we have got this positioning of buying into two-wheeler companies or Maruti for that matter. So we are reasonably constructive on the consumption space. Obviously, the multiples are much more reasonable after 3 or 4 years of practically zero return in most of these stocks.
All right, so perhaps a re-rating of the consumption pack, and you're looking at the rural consumption theme more, Aditya. But let's talk about the top buzzer of the day, the Nifty IT that's doing well today. I mean, that is, of course, on the back of the buyback that the Infosys has announced, and it's buoying the sentiment in the entire IT pack. But generally, IT has been an underperformer. There are global headwinds for IT. But if you look at the counterpart, the Wall Street, Nasdaq is sitting at record high. What do you pencil in for Indian IT sector? Because there are global headwinds, but the valuation seems to be quite attractive at this juncture.
So IT, to our mind at this juncture, the large cap IT companies, Infosys, Wipro, HCL Tech Mahindra, and TCS are more a capital allocation play. And, I'm not surprised with this, bit of a buyback news, why Infi is up today, essentially. If you look at Infosys balance sheet, they've got 25,000 odd crores of cash. We believe that, half of that could be, possibly buyback or a combination of dividend and buyback. If I look at the free cash flow yield of large IT companies in India or the dividend yield number, it is closer to 3 to 4%. And historically, what we have seen is that once you get into this 3 to 4% zone in terms of the large cap companies, it is a very good zone to do value investing essentially, and focus on just dividends. So this is where we are. Obviously, there is a lot of disruption. Our focus in this scenario has been to focus on companies which are aligned in terms of the enhancing capabilities in terms of generative AI. So we've got this company, R Systems, which recently did an acquisition, on the generative AI side. And we also prefer, product companies. We do believe that, the next decade will belong to product companies which can really innovate and benefit. So there is a company known as Intellect Design Arena, which we own in the portfolio. We believe that they have proven themselves in Southeast Asia, India, and the Middle East region, and now they are going global with a product known as Purple Fabric. So one has to be very, very choosy in this space. Obviously, we believe that service companies have headwind, but at the same time, we continue to have a small allocation towards a Wipro or Infosys, wherein we believe that these are good value picks at this juncture.
All right, Aditya, thank you so much for joining us and weighing in the market. So we'll let you go on that note, and it's time for us to slip into a short break. Don't go anywhere after the break. We come back with more updates on the market. Stay tuned.